All right, so you ready to dive into something that could seriously up your financial game? We're talking about dividend stocks today
Um, yeah, building long-term wealth.
and creating like a stream of passive income, right?
Yeah.
And the best part is this could work even if you don't have like a huge pile of cash to start.
Exactly. Yeah.
So maybe you can just quickly explain to me what a dividend stock even is.
Okay, so imagine this. You're not just buying a stock and hoping it goes up. You're actually becoming like a mini part owner of
Mm.
that company.
Oh, okay, I see.
And as a part owner, you get a slice of their profits.
So instead of just hoping that stock goes up, you get paid just for owning it.
Yes. It's called passive income, and that's what we're diving deep into today.
It's like you have this little money machine working for you if you need it.
Exactly. We've got some really great resources for this deep dive from Kiplinger and Seeking Alpha, and I think you'll find it really interesting just how accessible this strategy can be.
I'm all ears. Where do we even begin?
Okay, let's start with this idea of Dividend Kings and Dividend Aristocrats. Kiplinger uses these terms to talk about companies that have been increasing their dividends for over 40 years straight.
Wow. Okay, color me intrigued.
Yeah, some of the names on the list might surprise you.
All right, like what kind of surprises are we talking about?
Well, for example, you got Cisco, the
Mhm.
huge food service company. They've been paying dividends consistently since they went public back in 1970.
Oh, wow.
And get this, even Hormel, the company that makes Spam,
Yeah.
has a 51-year streak of dividend increases.
Wait a minute, Spam. The canned meat Spam. That's a dividend aristocrat.
That's right. It shows that a lot of these companies, they're not the flashy names everyone talks about, but they're the quiet achievers, the ones with a proven track record of sharing profits with their shareholders.
That speaks volumes about the long-term potential, right?
Yeah, absolutely.
So it's not just about chasing any company that pays dividends, right?
Yeah.
It's got to be these ones with a solid history. What else should we look for?
Well, both Seeking Alpha and Kiplinger really stress a few key things. Like, consistent dividend growth is huge, especially with inflation being such a concern. You want your income to at least keep up with rising costs.
Yeah, that makes sense. A stagnant dividend isn't going to help you if everything else keeps getting more expensive, right?
Exactly. And you also got to look at the financial health and stability of the company. Strong free cash flow is a really great indicator of that.
Okay, now free cash flow, if I remember right, is basically the money a company has left over after paying all its bills, its operating expenses.
You got it. And it's capital expenditures.
Right, right. So it's the cash they have available to either reinvest back into the business, pay off debts, or...
Distribute to shareholders as dividends.
Right, okay. So the more free cash flow, the more likely they can keep those dividends coming.
Yeah.
And maybe even increase them, right?
You got it.
Yeah.
So it's not just about the dividend itself, it's about the strength of the company behind it.
Okay, so we've talked about individual stocks, right? This whole idea of consistent dividend growth, strong financials. But what about taking like a more diversified approach, maybe with an ETF like SCHD?
SCHD, oh, that's a really interesting one. It's basically a simpler way to invest in a whole bunch of dividend-paying stocks at once. So you're not picking individual companies, you're getting exposure to a whole diversified portfolio with one purchase.
Less research, less monitoring then.
Right. You could say that. But the real draw with SCHD, according to Seeking Alpha analysts at least, is its laser focus on quality. They call it, and I love this, a dream ETF for dividend growth investors.
A dream ETF. Okay, what makes it so dreamy?
Well, SCHD chooses companies that have a solid track record of consistent and growing dividends.
So like those dividend aristocrats we talked about.
Exactly. It's almost like having a team of experts picking the best dividend stocks for you.
And what kind of performance are we talking about?
SCHD has actually outperformed the S&P 500 pretty consistently.
That's putting your money to work, right?
Yeah.
What kind of yield are we looking at with SCHD?
Right now, it's sitting at a yield of 3.54%. So just to give you an idea, for every $1,000 you invest, you'd be getting about $35.40 a year in dividends.
That's not too shabby for a hands-off approach, right?
Definitely something to consider, especially if you want to benefit from dividend investing without, spending hours researching each company.
So we're at this crossroads now. Individual stocks versus an ETF like SCHD. What are the trade-offs?
Well, with individual stocks, the potential for those big returns is definitely there if you pick the right companies, that is. But even their solid dividend aristocrats can face challenges.
You're right.
You're going to need to do a decent amount of research and keep monitoring how those companies are doing to make smart choices.
The Seeking Alpha articles, they really dive deep into the weeds, examining all the strengths and weaknesses of each company. It can be a lot to process.
Absolutely. And that's where an ETF like SCHD can be really appealing. It gives you that instant diversification, spreading your risk across many companies. So if one stumbles, it doesn't take your whole portfolio down with it.
That's like the don't put all your eggs in one basket thing.
Exactly. With an ETF, you're automatically diversifying, and that can be really good for folks just starting out or those who prefer a more set it and forget it approach. Of course, the trade-off is your potential for those massive returns might be a little lower because the ETF is tracking a broader market index.
So it's really about finding the right balance between risk and reward, and that's going to be different for everyone.
Exactly. It depends on what your goals are, how much risk you're comfortable with, and how much time you're willing to put into managing your investments.
Okay, so for someone just starting out, how do they even begin to build a dividend portfolio? It can feel kind of overwhelming, right?
Yeah, it can be, but it's simpler than you might think. The biggest thing is just to get started. You don't need a ton of money to begin investing.
That's good to hear, because I think a lot of people assume you need to be wealthy to even think about investing in the stock market.
That's a huge misconception. Even small, regular investments can grow significantly over time, especially with compounding working its magic.
Compounding, remind me how that works again.
It's basically earning returns on your returns, like a snowball effect, right?
Right.
As your investments grow, the returns you earn get bigger, leading to exponential growth down the line.
Right, so even starting small can lead to big things eventually.
Absolutely. And it's not just about the money either. It's about taking ownership and being part of the growth of companies you believe in.
Oh yeah, it's more than just numbers on a screen.
For sure. So, to get started, a good first step is setting aside a regular amount to invest, even if it's small. Consistency is key.
So it's about making it a habit, like paying yourself first.
You got it. Make it a non-negotiable part of your budget.
What about picking individual stocks? Where do you even begin with that?
Well, if you're interested in that route, think about companies that really interest you or that you already know something about.
So, like, if I'm a tech enthusiast, I might start looking at dividend-paying tech companies.
Exactly. You're more likely to stay engaged and motivated if you're invested in companies and industries you're passionate about.
And what if researching individual companies still feels daunting?
Well, you could consider starting with SCHD as your core holding. It's a solid foundation for getting exposure to a bunch of quality dividend payers, and you can always branch out into individual stocks later on as you get more comfortable.
So SCHD is kind of like the training wheels for dividend investing.
You could think of it that way. It's a pretty low-risk way to dip your toes in and get a feel for the market.
That makes a lot of sense.
And remember, the most important thing is to just take action. Don't get stuck overthinking everything.
That's probably good advice for life in general.
You're telling me. Do your research, explore your options, but most importantly, make a decision and get started. The sooner you begin, the sooner you can benefit from that compounding effect and start building long-term wealth.
All right, so we've talked about Dividend Kings, aristocrats, the importance of things like consistent dividend growth, strong free cash flow. We've even looked at the ETF alternative with SCHD. But now what about some specific examples? Something to really show what's possible with this strategy.
Oh, great question. I think the Kiplinger article has some fantastic examples. Let's take a look at Lowe's, the home improvement retailer. They've been increasing their dividend for a crazy 61 years.
61 years. Wow, that's longer than I've been alive.
Exactly. And they've managed to do this through thick and thin, recessions, housing market downturns, the whole shebang.
So they've basically proven they can handle whatever gets thrown their way and still keep those dividends coming.
Yeah.
That's pretty reassuring.
It is, and it shows the power of thinking long term,
Yeah.
focusing on companies that have a history of bouncing back from tough times.
Okay, Lowe's, got it. Any other standout examples?
Another one that caught my eye was Genuine Parts Company. They distribute automotive and industrial replacement parts. They've got an incredible 66-year streak of dividend increases.
66 years. That's almost as reliable as the sun rising. What's their secret?
Well, their whole business model is about providing essential products and services, things people always need no matter what the economy is doing. People got to keep their cars running. Businesses need to keep their equipment in good shape.
So they found this niche in a market that's pretty stable, even when times are tough.
Exactly. It really highlights how important it is to consider what industry a company is in when you're thinking about its long-term dividend potential.
Right. Okay, so Lowe's, genuine parts company. two solid examples of companies that have weathered the storms and kept rewarding their shareholders. It really paints a picture, right? Like this strategy, it can really work.
It does. And those are just two from a list of 17 companies Kiplinger highlighted. Each one has its own story, and they all offer valuable lessons about what makes dividend investing successful.
It makes you want to go down the rabbit hole with each of these companies, right?
Yeah.
Learn their whole story.
Oh, it's fascinating to see how they've adapted and innovated over decades, while still staying true to their core values and their commitment to those shareholders.
Okay, so we've looked at individual stocks, we've talked about the ETF option, we've even gotten into some real-world examples. But for someone who's listening and thinking, okay, this is all great, but I'm not sure I'm ready to jump in, what advice would you give them?
Well, first off, don't let that fear of messing up hold you back. Remember, every journey starts with that first step.
So it's about just taking action, even a small one.
Exactly. And one of the best things you can do is just start learning. There are so many resources out there, books, articles, podcasts, you name it.
So start soaking up knowledge, learn the basics, check out different approaches, explore companies you're interested in.
You got it. And remember, this isn't a race, it's a journey. It's about building that portfolio gradually, learning along the way, and staying focused on your long-term goals.
Yeah, it's easy to get caught up in the day-to-day ups and downs of the market. But with dividend investing, it's all about that long game.
Absolutely. It's like planting seeds, you nurture them and they'll grow and flourish over time.
And hey, maybe you'll even find yourself enjoying the process.
Investing can be intellectually stimulating. You're learning about businesses, analyzing trends, making decisions about where to put your resources.
Like a giant puzzle, but with real-world consequences.
That's a good way to put it. And the more you learn, the more confident you'll become in making those investment choices.
So educate yourself. Start small. Be patient. Those are great starting points.
Huh.
But what about the emotional side of investing? How do you stay calm and collected when the market inevitably throws those curveballs?
That's huge and often overlooked. Fear and greed, those are powerful emotions, and they can really mess with even the savviest investor.
Yeah, fear can make you sell at the worst possible time, and greed can make you buy at the worst possible time.
Exactly. That's why it's crucial to have a clear investment plan and stick to it no matter what the market's doing.
So you're basically creating a roadmap for yourself, like, okay, if this happens, I do this. A set of rules to follow when emotions are running high.
Exactly. Your plan should lay out your goals, your risk tolerance, how long you plan to invest. And once you have that, it's all about discipline, sticking to the plan.
So it's about having a strategy, not just reacting emotionally to every little market blip.
Right. And another great tool for managing those emotions, diversification.
The old don't put all your eggs in one basket strategy.
That's the one. By spreading your investments across different types of assets, different sectors, even different parts of the world, you're reducing your risk.
So if one investment goes south, it doesn't tank your entire portfolio.
Exactly.
Yeah.
And that can give you some peace of mind knowing you're not overly exposed to any one thing.
So a solid investment plan, a diversified portfolio, those can help you stay grounded when the market gets a little crazy.
Absolutely. And remember, investing should be exciting, a source of opportunity, not something that stresses you out.
Yeah, if you're constantly checking your portfolio and freaking out over every little dip, you're probably doing it wrong.
For sure, it's about finding that balance, staying informed, but not letting the market consume your every thought.
Stay informed, but don't let it take over your life, right?
Exactly. And one of the great things about dividend investing is that you're not just relying on the stock price going up, you're also getting that steady stream of income.
Yeah, those dividends can give you a sense of stability, especially when the market's being unpredictable.
Exactly. It's like having a little extra income coming in no matter what the market's doing.
Okay, so we've covered the strategic side, the emotional side, but now I want to shift gears a bit and talk about something that I think often gets missed in these conversations. I'm talking about the human element.
Oh, interesting. What do you mean by that?
Well, we've talked a lot about numbers, data, financials. But what about the people behind these companies? The stories of innovation, resilience, the impact they're making.
You're talking about the stuff that can't be measured on a spreadsheet, the qualitative side of things.
Exactly. And I think that side is just as important as the numbers.
I totally agree. Investing isn't just about crunching numbers. It's about understanding the stories, the missions, the values of the companies you're investing in.
So it's about connecting with the human side of business.
Absolutely. Recognizing that behind every successful company, there are passionate, driven people who are trying to make a difference.
And I think when you connect with those stories, it makes investing more meaningful, more engaging.
Right. Without a doubt. It's about being part of something bigger, aligning your investments with your values, supporting companies that are doing good in the world.
And that can be rewarding on so many levels, not just financially.
Exactly. It's about finding that sweet spot where your investments are not only making you money, but also aligning with what you believe in, helping to build a better future.
That's a powerful concept. It takes dividend investing to a whole new level.
It does. It becomes more than just a way to make money. It becomes a way to create wealth and live a more fulfilling life.
Okay, so we've looked at the strategic side, the emotional side, and now the human side of dividend investing. We've covered a lot of ground, and I'm sure our listeners are itching to put all this into action.
I hope so. And I want to encourage everyone, don't let this be the end of your journey. Keep exploring.
So where should they go from here? What resources can they tap into to keep learning?
Well, those Kiplinger and Seeking Alpha articles are great places to start.
Yeah, they give you a good foundation, insight into specific companies, market trends, different approaches.
Right. And beyond those, there are tons of resources out there, financial websites, blogs, books, podcasts, all dedicated to dividend investing.
And don't forget about the companies themselves.
Oh, good point. A lot of companies have investor relations sections on their websites. You can find detailed info about their financials, dividend history, future plans.
It's like having a direct line to the people running the show.
Exactly. The more you know about the companies you're investing in, the more confident you'll feel about your decisions.
So do your research, explore different perspectives, and never stop learning. The world of dividend investing is huge and always changing.
It's a journey of discovery for sure, and the rewards can be amazing, both personally and financially.
Well said. Okay, before we wrap up, I want to leave our listeners with one last thing to think about.
Okay, hit me.
We've talked about how important consistent dividend growth is when you're choosing stocks. But what happens if a company decides to cut their dividend or even get rid of it altogether?
That's a really important question. A long history of dividend increases is a good sign, but it's not a guarantee.
So what are some things investors should look out for to gauge the risk of a dividend cut?
Well, there are a few red flags. Keep a close eye on the company's payout ratio, which is basically the percentage of earnings they're paying out as dividends.
So if they're paying out a big chunk of their earnings as dividends, that could be a warning sign.
Yeah, it could mean they're stretching themselves too thin, especially if their payout ratio is much higher than the average for their industry.
Okay, high payout ratio, red flag number one. What else?
Watch out for a sudden drop in earnings or free cash flow. If a company is struggling to generate the cash they need to cover those dividend payments, a cut could be coming.
Makes sense. And then you've got external factors too, right? Like changes in regulations or a downturn in the economy. Those can make it hard for companies to keep up with their dividends.
Absolutely. It's all about staying vigilant and informed. Don't just assume that past performance guarantees future results.
So keep up with the news, read company reports, and watch out for those red flags. It's about being an active shareholder, even if you're taking a passive approach to investing.
Exactly. Knowledge is power, especially when it comes to your money.
Great point. Dividend investing can be a really awesome way to build wealth and generate that passive income, but it does come with risks.
Every investment has risks. It's about understanding them and managing them well.
So do your research, be ready for the unexpected, and always keep learning.
Words to live by for investing and for life in general.
Well said.
Mm-hmm.
We hope this deep dive has given you some valuable insights and inspired you to learn more about the world of dividend stocks.
Remember, building a secure financial future, it's within your reach. Just got to take that first step.
And don't forget, check out those resources we mentioned, the Kiplinger list, those Seeking Alpha articles. They're a great starting point.
And those company websites, take advantage of them. The investor relations sections can be gold mines of information.
Yeah, it's like having a direct line to the company's leadership. So much valuable information there.
Exactly. Be proactive. Find the information you need to make smart choices.
All right, there you have it. Our deep dive into dividend stocks, from Dividend Kings and Aristocrats to the pros and cons of individual stocks versus ETFs.
We talked about what to look for when choosing dividend stocks, and even got into the psychology of investing, how to make a plan, understand your risk tolerance, and stay disciplined even when the market's doing its thing.
But most importantly, we wanted to give you the tools to take action. Start building that financial security through dividend investing. Remember, it's a marathon, not a sprint.
Start small, keep at it, And never stop learning. The rewards are worth it.
Well said. On that note, we'll wrap up this episode of The Deep Dive. Until next time, keep exploring, keep learning, and keep diving deeper into the world of knowledge.
Yeah, it's like peeking behind the curtain, seeing how they make their decisions and what they're planning for the future.
Exactly. And it helps you stay informed about anything that might affect your investments, whether it's good or bad.
Okay, so let's do a quick recap of our deep dive into dividend stocks today. We started by talking about those Dividend Kings and Aristocrats, the companies with that impressive history of consistent dividend growth. Right, and we talked about how to evaluate those individual stocks, looking at things like their financial health, their business model, and whether they're truly committed to sharing those profits with their shareholders.
And then we looked at the other option, investing in a diversified dividend ETF, like SCHD. The simplicity, the diversification, the potential for steady returns.
We even got into the psychology of investing, the importance of having a plan, knowing your risk tolerance, and staying disciplined when the market gets a little wild.
But at the end of the day, we really wanted to give you the tools and the confidence to start your own journey with dividend investing. It's about building a strong financial future for yourself, one step at a time.
And it's not about getting rich quick. It's about building that foundation slowly and steadily.
Start small, stay consistent, and never stop learning. It's a journey, and it's worth it.
It really is. The rewards can be life-changing.
Well said. That wraps up this episode of The Deep Dive. Until next time, keep exploring, keep learning, and keep diving deeper into the world of knowledge.